Hi, this is Andy McDonald, the Chief Financial Officer for HumanGood. I wanted to take a minute to walk you through the 2020 preliminary financial results for the year. So let me share my screen. So we're going to take a quick look at the financial results for the year. We're going to more specifically look into the life plan community occupancy and sales pipeline. We're then going to take a look at the balance sheet and income statement for HumanGood, and then finally finish up by looking at the bond compliance calculations for the different obligated groups of HumanGood. So looking at our annual results for the year, actual, budget, and then relative to 2019, you can see despite all the challenges that we've had and been speaking about with the pandemic, we've actually been able, through a number of cost control initiatives, funds received from HHS, right here, this 13.3 million, we've been able to actually have one of our stronger operating margin years. And something that we've been messaging for some time is the desire to get to a cash operating margin that's positive. And we were able to do that in 2020. So again, operating margin is cash revenues less cash expense, and you can see the improvement relative to budget and the prior year. Cash operating margin is the operating margin less interest expense. Part of this positive driver that will help us even more next year was the financing that we did in late October. That lowered our interest rate quite a bit in the California obligated group, and that will reflect in lower interest expense. And you can see again that improvement relative to budget and the improvement relative to last year. And we'll look at that a little more specifically. Entry fees, you can see, was a real challenge area. This is very much tied to declines in our occupancy, which I'll speak to in a few slides. But you can see here that we were about $28 million behind budget, and then add on about 7 million lower than that versus the prior year. So that's been a challenge. We had a lot of refunds hit us in December, which has customarily been a strong month. We were okay with that because we had the cash position to handle those refunds, and that actually sets us up stronger going forward. Those were contractual obligations that were due. So that is out of our way and will position us better going into 2021. And then, as I spoke to, we've received about $14 million from Health and Human Services. We've recognized the majority of that, over 13 million. And we've spent a decent amount of it covering incremental, non-budgeted COVID expenditures, PPE and things of that sort, disinfection and other related costs. Okay, so looking a little more specifically, some of the highlights for the year, our cash and investments, and you'll see this on the balance sheet at year end, was up 16.4 million for the year, or about 3%. That's very helpful. It helped us to not have to defer nearly as many CapEx projects as we thought or were planning to. So we were able to hit our capital expenditure goals, keep our communities refreshed and the infrastructure in good shape. So we're very happy about that. All of our obligated groups, as I'll show you on the last slide, were in compliance with their covenants at year end. As I spoke to, the entry fees was a challenge area. We were down 43% relative to budget. So still overall to be up in our cash position despite this challenge is very encouraging. We had a very strong investment year. As you probably saw, the markets rebound substantially from their March lows. And then our major redevelopment project is Rydal Waters. And we have sold so far 43 of the 75 cottages and had 23 move-ins to date. So despite everything going on, we are substantially on track there. And that continues to be an area of focus of how we can complete the sales and fill process for this addition to Rydal Park. So turning to occupancy on the life plan communities, you can see the chart here at the top, HumanGood West, and at the bottom, HumanGood East. I'll just point to a couple things to keep an eye on. Well, overall, our occupancy, residential living, you can see a little under 90%, so over 3% below budget for the year. Assisted living, very similar, about 3%. Similar theme for our memory support apartments. And finally, you see the big challenge area here is the skilled nursing. That's a function of not being able to get post-acute admits from hospitals. So that's something that we've been dealing with all year. You can see on the chart here, you've got your residential living in blue, that kind of slow decline. Yellow is assisted living and orange is memory care. You can see a lot of chop in between here, but ending substantially around where we were at the beginning of the year, though a little bit lower, but you really see the impact dramatically here in the skilled nursing. So this is all of the 21 communities less the 3 here. And you can see this bottoming out. We were kind of getting a recovery. And then, we're actually ending the year at our lowest point. That was that second wave you've been hearing about. And that really slowed things down going into next year. So this will be something we're going to have to really focus on from a 2021 budget perspective. A lot of assumptions in that budget have us making a recovery, trying to work our way back much closer to where we started 2020. That's really our objective, to kind of fully unwind this downturn by the end of next year. But what we've experienced since we finalized that budget kind of in this time frame, this better time frame, is this decline that's going to make it harder. That means we're going to have to be more vigilant in how we manage our costs, in our work to fill open apartments, and our skilled nursing. So we definitely have our work cut out for us. Everyone's aware of this. We're already taking steps to get where we need to for 2021, but there will be challenges that we're going to have to work through from an occupancy perspective. And this is more forward-looking. Occupancy looks back at where we've been. This looks forward. This is our sales pipeline. So this top blue bars here, these are new accounts for prospects that we're opening in our Salesforce software. You can see when COVID hit, there was a real decline here. We were able to build that back up post start of the pandemic. We see we kind of peaked out in August, and then there was a little bit of fatigue here as we went into the end of the year in terms of the ability to get new prospects. But you can see a nice rebound. So this is hopeful, this sharp uptick in January. That helps us quite a bit as we position ourselves to refill in 2021. Below is website activity. Again, similar theme, up, peak, down, and then kind of a flattening out. Taking a look at our balance sheet, some of the themes we already spoke to. There's that nice cash and investments here, 583 million relative to where we started the year. I'll jump down here. This cash and investments, that's this number, as a percent of serviceable debt, that's this number, about 64%. So what does that mean? That means we have a strong cash position. Serviceable debt is the debt that we have to pay regular principal and interest payments on. So in layman's speak, we have enough cash in the bank to weather through the pandemic. This is what helps me sleep at night, seeing that our cash position is strong. We want to see the markets maintain their gains or add to them. That has been helping us quite a bit. But all the effort that we've been spending on financial management and cash management has been paying off. And we come out of a very tough year in an actually stronger cash position. So very, very pleased about that. Taking a look at our income statement here, you can see that hit from the occupancy declines that I showed on the occupancy slide. You can see that $25 million lower revenue relative to budget and 10 million lower than last year, even though we had normal rate increases going into 2020. Then here is the funds. That's the 13 million from Department of Health and Human Services through the CARES Act. So a portion of that came down here and helped defray these COVID expenses, and the rest came up here and helped defray this lower occupancy and decline in revenue here. Also, steps that we've taken through our cost mitigation efforts that have been spoken to in previous videos are showing up here. We've got the lower employee costs relative to budget, about $16 million lower than budget, about $3 million lower than last year, even though we had normal wage increases to start the year. So a lot of good work in managing our costs there, lowering overtime where possible, is really showing dividends here. It's helped us tremendously in managing through this challenging year. You can see other operating expenses are lower. These are ancillary expenses related to skilled nursing occupancy being lower. Travel was down over $2.5 million relative to budget. So our travel restrictions helped us financially managing through these times. And then other reductions in things like utilities and purchase services have helped there. So what you get at the bottom line is this operating margin, again, that I spoke to, and that nice outperformance and that positive cash operating margin. So if we just take the cash operating margin, this line here from the previous slide, this 42.8 million, this just breaks it out by the different entities and then the different business lines. So just the general themes relative to budget perspective. The California Obligated Group outperformed the budget, did strong there, outperformed the prior year. So we like to see that. We've had ongoing challenges at the communities outside of California. We call it our National Obligated Group and some related entities. So you can see that underperformance here. So we stay very focused on these 4 life plan communities. These are the numbers for HumanGood East, formerly Presby's Inspired Life, excluding their affordable housing. So a nice outperformance here and here. And then if you look at the affordable housing, you can see real strength there. This is the East and West Affordable Housing plus Beacon Development Group. All had nice years, great job there, and the work that's being done to control their costs. Their occupancy remains strong in the communities. There's high demand. You can see that we spent less at HumanGood Cornerstone, lower cost for some of the board meetings and things because they were done remotely. Some of the affiliation and integration costs came in lower than anticipated. So we had a nice pickup here. And then the foundation had a nice year. They outperformed their budget in terms of total collections on contributions. And we like to see that. So going here to the operating margin by business line, again, you've got the life plan communities outperforming budget, affordable housing, very strong year, and then the others that I spoke to having nice outperformance. Finally, I'm going to finish up with the bond compliance ratios. There's 4 key obligated groups. There's the California Obligated Group, that's the 14 life plan communities in California. The National Obligated Group, that's Judson Park and Terraces in Phoenix. It's an obligated group of 1, but the HumanGood Nevada or Las Ventanas. And then the HumanGood Pennsylvania, that's the former Presby's obligated group, and that's 3 communities in Pennsylvania. And so what we see here is compliance, though quite close for both Las Ventanas and the National Obligated Group. They were in compliance, lower than customary in HumanGood Pennsylvania. Entry fees were well down versus budget. There was over $10 million budget variance there, but still we're able to be in compliance. So we're able to manage through a very challenging year. The California Obligated Group was below its customary levels. It was at about 3.3 times, 3.3 last year, down to about 2.6. But again, that was with a substantial difference in entry fees year over year. Cash position remains strong. You can see here, HumanGood Pennsylvania, even the challenges in the cash flows or debt service coverage ratio, that's the cash inflows that are needed to see how many times over you can service your debt service, the amount you pay to your bondholders. So 1.96 times, for example. Here's the days cash on hand, which is basically how many days of expenses could your cash and investments balance cover. So 614 days, you're starting to get close to 2 years worth of days cash on hand. That is tremendously strong. So despite a down year in cash flows, a very strong year in terms of cash balances. You can see we're right on here with Nevada. That's somewhat by design. We sweep excess cash above 90 days to pay down debt. The national obligated group, even though challenges and very close in compliance on the cash flows, again, a strong cash balance. And finally, the largest obligated group, the California obligated group, very strong cash position. This was at 401 days last year. So again, we've strengthened our cash, even though our cash flows have gone down. So that's what I wanted to share with you today. I hope that gives you somewhat of a picture of the 2020 financial year. It's been a tough year. The team has done a tremendous job managing through the challenges. We're still right in the middle of it, so we're still managing through. And as I showed, we have our work cut out for us in 2021. But I have 100% confidence with the work that the team's done, the resiliency that they've shown, that we'll be able to successfully manage through 2021. And as long as we're working through the impacts of the pandemic. Okay, it's good to talk to you all. I look forward again to the day we can be in person again. Take care and be safe.